Guys and gals, thanks for showing up. We got Stuart in the house. Nice.
Hey,
Stuart's one of my
Stuart.
partners. Stuart's one of my partners on several deals for some medical office buildings. Stuart, how you doing, bud?
Well, I don't
Anyways,
think I knew you were partnered with Stuart on stuff. So for those of you that are on this call, Stuart's an amazing guy. So love that.
hard worker, man. Dude
Yeah.
works all the time. All the time. We'll give it another minute here just to allow some other people to come in. And so we'll get this kicked off by 12:03. Shouldn't take that long, right, Court? Probably
Nope.
30
Nope.
minutes
And
or
we
so.
can, yeah. And, we can make it as short or as long. I have to actually focus and not go down all the rabbit holes.
Yeah.
It's easy to do. And then we can even take questions at the end if anybody has any questions about anything. It's such a great topic. And before we even talk about that, like if even if you think it's a stupid question, it's not. It's such a complex asset class. And I think there's always some hesitations around, not even knowing you don't know what you don't know. Cause I feel that way about real estate. When I got into alternatives, I was like, man, I don't even know what a cap rate is, and I don't even know what questions to ask. And so
Yeah.
I'm always that dodo bird in the room with an entire room full of real estate people going, what is this? And it's always really easy stuff. And, but it is,
Yeah.
it is. It's all good.
Yeah. Yeah, for sure. All right. Well, we got a strong list of attendees so far. Bunch of great guys in there. Know a lot of them. All right. And Courtney, I just made you the co-host as well, so you'll
Perfect.
be able to share the presentation.
Okay.
That
Awesome.
way you're
Well,
not asking me to click to the next slide. All right,
okay.
guys. Well, I tell you what, we'll go ahead and get started. We'll get kicked off. Anybody else that's coming on, this will be recorded and sent out to everybody that signed up. Um, so that way you can go back through and look at things and this, that, and the other. We can even send you the slide deck if you'd like. Um, so, guys, I'm Charlie Wessel, Cordell Capital here in Charleston, South Carolina. I'm looking at the list and I know just about everybody on there. So yeah, we've been here for 20 years. Started Cordell Capital back in 2016, 17, and I've been on a run. So anyways, I'm going to go ahead and introduce Courtney Moeller. Courtney is a U.S. Navy veteran, Amazon #1 best-selling author, international speaker, seasoned entrepreneur. She was born into a family of oil professionals in the Permian Basin. Courtney spent the last 15 years investing in and drilling wells across Texas, Oklahoma, Colorado, Wyoming, and North Dakota. Her experience spans real estate, precious metals, self storage, and Bitcoin. Her passion lies in helping others build wealth through tax advantage oil and gas investments, which is what we're about today. Guys, the tax advantages on this are incredible. It's better than anything I've seen in real estate, I can tell you that. With a background in aviation electronics from her Navy service aboard the USS Nimitz, Courtney began technical precision and mid-driven leadership to every venture she touches. Her father actually started Pyrex Partners a long time ago, and Courtney kind of inherited that business. I'll let her talk about that here in a minute. And so she's grown up, guys. Like in high school, they would go and have parties in the oil fields, kind of thing. I mean, this is like some out of a Texas movie or something,
Well,
really.
it's like,
Some oil movie.
everybody saw Friday Night Lights. We'd go to the football
Yes.
games and then
Yes.
literally pop out to, whatever pump jack we were going to hang out at. And somebody would bring a keg of natural light because they were like $30 back in the day. It was great. It was a lot of fun. But, just to even add on to what you were saying about my dad's business, I think one of the coolest things about what he did, because he is a petroleum engineer, is back in the 70s. So back, 50, 50 years ago. He was a petroleum engineer. One of his best friends was a geologist, and I can't remember what his other friend did, but they would go and find oil and gas out in West Texas, and then they would package that deal up and sell it to like Chevron and Exxon and those companies. And so I got grandfathered back into a lot of the deals and these mineral acres, back from a long time ago. And some of those wells that got drilled back in the 70s are still producing and in my portfolio today, which is pretty cool.
That is very cool. That is very cool. Guys, the fund that we've created is Iron Horse Energy Fund 2. Energy Fund 1 was out last year. They raised a lot of money for it, and it's done very well. Courtney's done very well in the oil and gas, along with her whole family. I think her brother and sister, they all work in the oil and gas industry. Um, yeah, you guys ever seen the movie Landman? This is the real life landman. She has got a guy named Rick who's her landman, and he's got other landmen that work for him. So Rick is the Tommy Norris of our fund, and she's got a team of 25 plus people that are all out. Everything from landmen to geologists to CPAs to everything else under the sun that's part of the team that's putting this whole fund together.
Yeah, and I think that's, I didn't know you were going to bring that up, but it's really important because this is not something that, I didn't just decide to switch to oil and gas from another asset class. It's not something that I just one day thought, I'm going to go manage oil and gas deals. Like this is, we've lived in the United Arab Emirates. I've lived in Pakistan and Abu Dhabi, drilling oil with my dad, and then he drilled in Jakarta for 20 years before he retired, along with, all of the ownership interest that we have throughout the Permian Basin. My brother did all of his drilling throughout the Permian Basin. So this isn't just something that, we decided to do. And my partner, Rick, his background is very, very similar, comes from an entire family full of, oil and gas professionals. He was actually in the Navy. We figured out at the same time, we were both stationed in San Diego at the exact same time. He was the executive officer of a submarine while I was on the Nimitz. And he got out, got his landman degree, and has been, he's put together more than 180 oil and gas deals now. So very seasoned. We've got a fantastic team of professionals and a 5-person in-house accounting team. And I'm very grateful for it, very thankful. We switched to the fund model last year, and the fund's been great. It's all about diversification.
Yeah, and guys, just to let you know, I have known Courtney for like what 4 or 5 years now. Court,
Yes.
we met in a mastermind group that we were members of. Me and her and a few other people just kind of latched onto each other and started hanging out at these conferences and stuff like that. And we've had some pretty good talks around some fire pits around the country, and
Yes.
in Mexico and
Yes.
Arizona and LA, all over the place. And yeah, so I know what kind of workhorse we're hitching our wagon to here. Not to call you a horse, Courtney, but
Hey, you know what?
she is
It's
a
the year of
hard
the fire
worker.
horse. It's good.
Yeah, yeah. So, anyways, I have been sick for the past week. I sound terrible. I'm going to put myself on mute so everybody doesn't hear me cough. But Courtney, I'll let you take it away with the presentation.
Okay, perfect. Well, let me, and I'm getting over some allergies and nonsense too, so I apologize for my raspiness. Let me share my screen and we will just move right into present. And can you see everything okay? Perfect. Well, now that we just spent all this time kind of going over a little bit of my history and background, I won't, force you to go through any of that anymore. But let's go ahead and get started and even talk about why should you even think about bringing oil and gas into your portfolio? And I think something that is really important, besides the tax benefits, which guys, the tax benefits are pretty phenomenal. We're going to get into those here in just a minute, but oil and gas tax benefits are unmatched pretty much by any other asset class. But oil and gas is a fantastic way to diversify your portfolio. It's typically inversely related to real estate. So a lot of times when you see real estate going really strongly, oil and gas might be a little bit struggling. And then it kind of flip-flops. And I have gone through the ups and downs of the markets. I have been through $130 oil. I've been to sub-zero oil. So I have lived through, the ups and downs of what oil and gas is. And diversification is just, I'm very big on it. I think you should be in multiple asset classes that are not correlated. And it's a lot of the foundation of what I'm building. It is the foundation of what we build. So the monthly passive income is fantastic. So we do pay monthly payments. It's not quarterly, and the payments are very different and they're nice. It's a great hedge against inflation. Typically, when you see inflation rising, because oil is tied into pretty much everything that we do and all of our products, it pushes up oil prices as well. And the smart money. So I talk a lot about this because anytime I'm going to make some kind of investment, I always want to take a look at, where's Warren Buffett going? Where are the institutional funds going? Where's the smart money putting their money? And a lot of times you have to really kind of dig, you know, you got to kind of read between the lines of what's in the headlines and what's actually happening. Because, this whole last year, we kept hearing so much about oil's going to $30, yada, yada, yada. We've been living in this $60, $65 price range for quite some time. Well, what that has done is provide a fantastic acquisition time frame, which means, our buy prices for these assets has been lower. And what that has done is given us even better, K1 losses for our investors. So we are going to dig into that K1 loss, but because we had lower acquisition prices last year, our Iron Horse Energy Fund 1 investors are going to have more than a 90% K1 loss for last year, which I'm very excited about. So, and we're able to pack more assets into the deals. So it's great. But over the course of this last couple of years, and it's really was strong this past year. I mean, we have seen Warren Buffett, go hard and heavy into Occidental. And last year, they actually also acquired for $10 billion their petrochemical company. Um, Abu Dhabi and the UAE, they drill their own oil, but they launched a $5 billion fund that is acquiring working interest assets like what we do in the Permian and Bakken basins here in the United States. And we have just seen all of these private equity funds and everything. Even JP Morgan has launched like a $1.5 trillion energy fund, I think last year, either last year or the year before. And 5 billion, I believe, of that 1.5 trillion is completely dedicated to working interests. And so it's interesting, we see all of this doom and gloom and demand is going and actually the all of these companies that are publishing these articles have come back and said, never mind, demand is continuing to go up. And we have not been doing the amount of exploration and drilling that we need to do to keep up with that demand. So at some time here pretty soon, and I don't know if that's 6 months or a year down the road or a year and a half, but we are going to feel that lack of investment and lack of drilling when that demand finally goes above and beyond. So we do have a little bit of extra oil right now, but it's not like what they're saying in the headlines. It's a very, very small extra amount of oil. It's not this massive, huge, gluttonous, surplus. So small enough to where any kind of geopolitical anything can really have an impact and shoot prices the other direction. So okay, this is something else I love to talk about and address because I always get asked, well, aren't electric vehicles going to eliminate the need for oil and gas? And the answer to that is no. And I really like this slide. I wish I had 2025s. I don't have it yet, but this is such a great visual. I'm such a visual person. But in 2023, you can see that a lot of our energy, 82% of it came from carbon-based fuels. And that is like your oil, coal, and natural gas. So it was 82% in 2023. Well, in 2024, it went up to 86.5%. So you can see oil went up a couple percent, so did coal, and so did natural gas. And then up here, can see on this slide on the left, let's see, our other renewables. This is going to be your solar, wind, all of that kind of stuff. It went from 8% down to 6%. A lot of these companies are actually rolling back, people that had put in this renewable energy and wind turbines and all of this stuff, they're taking them back out. So the numbers for that have actually gone down, and the amount of coal and oil and gas use is going back up. And even actually, a lot of the companies over in Europe are countries that had put in these windmill farms and solar panels, they're taking them back out and going back to natural gas. So I think this is such a powerful slide. And with that, this is one of the other things that I love to talk about, because a lot of people, when they think about oil and gas, they think about fuel for their cars. But what a lot of people don't realize is there's so much more to oil and what it is made. And in the oil and gas industry, you've got three sectors. You've got upstream, midstream, and downstream. So upstream is where you're out drilling oil, right? You're out drilling wells, pulling that oil and gas out of the ground. Midstream, that's all your pipelines and your trucking. And then downstream is refining oil into other products. And guys, everything just about has oil in it. I mean, plastic, if you're on a computer or a phone right now, it needed oil, it needed petrochemicals to be made. It's in sports balls, asphalt, tires, makeup, medical equipment, aspirin. I mean, it is literally in everything. And a barrel of oil is about 42 gallons, and this is a really, really rough estimate, but about a third of that barrel will go to fuel for cars. About another third goes into making products like you see on the screen, and about another third of that goes into making diesel and jet fuel. So, fuel for airplanes, and then fuel for like our agricultural equipment and things like that. So, I'm sorry. I feel like I'm very raspy too, Charlie. We're two peas in a pod.
I'm telling you, I got sick kids at home. That's what did it to me.
Yes, gosh. Okay, so the tax benefits are phenomenal, and this is why everybody comes to me, especially in November and December at the end of the year, because the tax benefits for oil and gas are very special because they have the potential to offset any kind of income. W-2, your job, if you've got active income from other investments, passive capital gains, capital gains from real estate, from selling stock, from selling Bitcoin. And you don't have to be a material participant. So just by making the investment, you get that K1 loss in year one just from the investment, which is fantastic. But here's the catch. It has to be a working interest. You can't invest in like a royalty or something else. It has to be a working interest. Decades ago, and this has been around for decades, decades ago, the government stepped in and said, it's really risky to drill an oil well. So we're going to give you guys some incentives to go out there and do it because it's really expensive. I mean, these wells, cost anywhere from $5 to $15 million a well to drill. Well, if you don't hit oil, your money is gone. And because it was so risky, they put these incentives in place so that it wasn't a total loss. Well, that's very much changed today. We'll talk about that here in a minute, but you get those active losses from something called intangible drilling costs or IDCs. And that is everything that goes into drilling the well that doesn't have any sellable value later. So things like fuel and labor, things that you can't, recapture. You also get the tangible drilling costs. So this is stuff that does have sellable, value later on down the road, but it's very, very minimal. The big portion that, everybody is interested in and pays attention to are those IDCs. And then if the IDCs weren't big enough and great enough, you also get something called a depletion allowance. And what this means is the first 15% of your income is tax free for the remainder every year in perpetuity. I know that there's been some, changes in states. I definitely always recommend everybody, talk to their CPAs. I'm not a CPA, confirmed that, there's not something crazy going on if you live in California or, some of these other states, because they have definitely made some changes here recently. And, I've been trying to keep up with it, but it's tough. So Obviously, you don't ever want to let the, tax tail wag the dog, but here is a really good example of this in place. So let's say you make $500,000 a year and you're in the 37% tax bracket. That means your tax liability for the year is $185,000, which to me should be illegal all on its own that anybody would have to cut that much of their money to the IRS, but that's another story and another conversation. So let's say you make an investment into an oil and gas deal that, Charlie's got, and the first year IDC deduction, we're anticipating it's going to be 85%. That means 85% of your investment or $85,000 is the K1 loss you're going to see in year one. That means your taxable income just went from 500,000 down to 415. And in actual dollars, that's a little over $31,000. So obviously your tax bracket and everything else matters, but your at-risk investment just went from $100,000 down to 68 right off the bat. And that's keeping dollars in your pocket. Did I skip? Nope, we're good. So, okay. Let's talk about the risks because this is something, every single deal out there is going to come with risks. There are definitely great ways to mitigate them, but these are the things that every single person, whether you're assessing a deal with Charlie or you're assessing a deal with any other oil and gas operator out there, these are the things that are going to impact every single deal. And I don't care if you are Exxon or if you are the smallest operator out there, the returns are always going to be uncertain. Nobody can guarantee what the price of oil is going to be, and that's that commodity price. That is going to impact every deal. And so, we do conservative underwriting, and I think the way that you mitigate that commodity price risk is you want to make sure that you are investing in a deal that has a very low break even price. And we only specifically participate with really big companies like Exxon and EOG and Continental. And most of the break even prices fall between about that $35 and $40 price range. So even at the $60, $65 area, we're still making money. I mean, I'd rather oil be sitting at $80, but we're still doing great. But a lot of the smaller operators, their break even price is about $65. So a lot of them have gone offline. There's been a lot of consolidation that's been happening in the oil and gas space, but that is probably one of the number one questions to ask is, what's your break even price? This third one, no assurance that oil or gas can be found or that if it is found, it will be of sufficient quality to pull it out of the ground. So let's say they hit oil, but then they either can't get it out of the ground or there's not enough there to actually start pumping it out of the ground. That is another issue. I will tell you the way you mitigate that is there are a handful of top producing basins in the United States, and they run right along the central United States area. And up north in North Dakota, it's the Bakken. Wyoming, Colorado is the Niobrara. You've got the Anadarko in Oklahoma. You've got the Permian Basin and Eagle Ford areas here in Texas. If you're drilling in those areas with one of these top operators and drilling a horizontal well, the success rate for those is more than 90%. And I can tell you that my partner Rick and I combined, we have participated in more than 1,200 wells. And of those 1,200 wells, we have only ever had 10 that either didn't produce or didn't have or was just a dry hole. So the days of that happening because of who we participate with is pretty much gone. This last one is the last one that I want to talk about is your monthly operating costs exceeding your monthly production members. So what that means is, when you have a working interest, you've got monthly bills that come in because you've got to pay to keep those wells up and running. Now, going back to your break even price, if your break even price is $60 and oil is sitting at $50, you're probably not making enough money to cover those monthly operating expenses. So you need to make sure, whoever you're investing with, what is their plan if that happens? Are they passing those costs on to the investors? Are they covering it? What does that look like? But it can happen. I've had it happen twice now in all of my, gosh, I inherited my dad's company in 2011, so 15 years. I had it happen 1 month back in 2016 when sanctions were lifted against Iran and prices tanked. And then I didn't have it happen to me during COVID. My partner Rick had a couple of wells that, when prices went down below zero, it impacted a couple of his projects. I did not, but I can tell you, here recently, about 2 months ago, they went in and did a workover on a well to re-stimulate. They went in to refrac it and, make the oil come out faster. And so because of that bigger expense, I actually ended up having to cut a check that month to cover that workover cost. So that is something that can happen. It's just important to make sure that whoever is managing the deal that you're getting into, they've got, some kind of contingency or something in place for when those things do happen. So let's talk about due diligence and criteria. Hang on, I'm going to just check. Okay, yeah. I've got a couple of different ways that I assess deals. Now, if I'm putting together a deal for investors, this is really kind of my criteria on this page. First of all, it's got to be a major operator. I've got this handful of things. If it's got to be a major operator in one of those top basins that I was telling you about, we've got this handful, but all of these things are here. There's got to be a minimum of 4 wells. And if we're underwriting this deal at $65 oil, how long is it going to take to get, the capital back? How much are we expecting these wells to produce? How much oil, how much natural gas? Have they already gotten permits approved? Where are they at in the drilling process? One of the things that I love about what we do is we come in and buy these assets typically when they've already started drilling or they've just finished drilling and we're waiting for them to frack and bring them online. And every now and then we're able to acquire some that are actually already online. So, which is pretty great. They've just finished drilling. Um, the other thing we take a look at is, okay, if we're expecting, these wells to produce, let's say 800,000 barrels of oil, is that typical for the area? That's that offset production, is what we think it's going to do and what the operator thinks it's going to do. Is it typical for the area that it's in? So we've got a really, really, really great, underwriting criteria. Like I said, right off the bat, who's the operator? Where are they drilling? Is it a minimum of 4 wells? What's that return of capital and what's their break even price? If we can be like, okay, check, 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 what's our acquisition price? And we're good there, then we'll kind of move on to some of these other questions. But these are all things that you need to look at regardless of who the operator is. Now, I don't bring investors into smaller operators. But if we are looking at a smaller operator, I've personally invested into some smaller operators. I am going to take a look at what that person's experience is. I'm gonna pull their production history. I'm gonna pull how many wells they have done. And let me tell you, the other thing is, I've got a handful of operators that I know. The oil and gas space is very, very small. Everybody knows each other. So I start making phone calls, what do you know about this operator? What do you know about this person? Because they all know everything. And I run background checks. I check all of these things. I might hire a geologist to come in and, check their geologist work. I don't have to do all of these, things. I don't need to run background checks on Exxon. I don't need to have a geologist check Exxon's homework because I promise you, these these major operators, they have almost all the skin in the game. And if they're spending $100 million to go drill some wells, they've done their homework. And I don't need to come back and check it. I just need to make sure that the numbers and the metrics fit what we want for our investors and that our acquisition prices line up with the tax benefits and everything else. So it's a little bit different, and that's why I have one for bigger operators and smaller ones. If it's a smaller operator, I've got to check everything. So, rolling right along into that due diligence, what a lot of people don't realize is that these oil and gas interests are recorded at the county just like real estate is. And so over here on the left, this is something called a wellbore assignment. And this is a deal that we did back in 2023. And on here, you can see over here on the left, there's 12 wells listed right here. And each one of these, this Denver Fed, Jack Fed, Cali Fed, that's the actual name of the well. And then on the right side, you see the API number. The API number is like a serial number for a well. It's assigned, and it is how all of the federal regulated information for that well is stored and recorded. And oil and gas is very, very federally regulated. And so each state has a governmental agency that regulates everything. So when we purchase these, our team of landmen, go in and make sure that the people selling it actually have the legal rights to sell it. Everything gets recorded. And so we get these assignments. Then over here on the right, this is the Wyoming Oil and Gas Conservation Commission site. You can go in and plug in either the well name, the API number, and you can pull up the information for that well. And what's really great, you can get the permits. I mean, you can see everything. You can see their files when they file their intent to frack. I mean, every single document associated with that well, it's all public information and you can get it off this site. But the other cool thing is you can see that this Cali Fed well, they got their permit approved on, September 26th. The spud date's the day that they actually broke ground and started drilling that well. And this one was spud on, March 20th of 2023, and it was completed on August 26th of 2023. You can see that well is 22,000 feet long. So it goes down 11,000 feet. So it goes down vertically about 2 miles, and then it goes out sideways about 2 more miles. And I'm always amazed when I see that to think that people are drilling these, 4 or 5 and sometimes 10-mile, holes into the ground to recover oil and gas, which is just incredible. The other cool thing is you can see how much oil it has produced, how much gas it's produced, and the water. And so this is a little bit old. This was from back in 2024. But the great thing is part of our accounting team, when we get paid by these companies, they go in and take a look at what was reported to the government on what they produced, and we make sure that matches the check that they sent us. So we need to make sure that we're actually getting paid for what's being produced. And because many of these companies are publicly traded companies, we don't have to worry about them holding money back or anything like that. That does not happen, not with the companies that we deal with. So earlier I mentioned offset production. These wells right here, this was a 4-well unit that we did with EOG back in 2024, and I talked about the offset production. So one of the things that we take a look at is, what do we think these wells are going to produce? How much oil, how much natural gas? And I think these we were expecting about 800,000 barrels over its life. And so what we do is we sit back and go, okay, where are all the producing wells around it? Who are those operators? And, how are they doing? I mean, gosh, this one well right here, it came online in 2015 and it's already produced 1.1, million barrels of oil. Some of these are sitting at 400,000. This one at the time had been online for, 2 years and it had already produced almost 400,000. So we take a look at what they've already produced, what the other wells are expected to do, and make sure that that's in line with what we're expecting our wells to do as well. It's not any kind of guarantee or anything, but it's definitely a smart way to take a look at kind of the bigger picture of what's going on in that area. Okay, so that is all I have. Oh, this is actually, we're going to skip all that part. Those were actual examples of K1s, but here is Charlie's information. And I think at this point in time, I'd like to, see if anybody's got any questions about anything. I will stop sharing my screen.
Yeah. Hey, Courtney. So we have two questions from Chip Mattis, who's an investor of ours. What can you pull up the Q&A
Yeah, I got it. I
sections?
got it.
Okay. All right. Yeah. Yeah. So the first question, what portion of the fund focuses on wildcatting versus the projects in proven developed areas with the majors? And just explain quickly what wildcatting means so that everybody else will know.
Yeah, and this is a really great question, Chip. And so we don't participate in any wildcatting. If we're going to go in and put investors' money into stuff, you do have the potential for much bigger upside, but you also have a much bigger potential to lose all of your money. So wildcatting is when you go and drill in an area that they think might have oil they're exploring, and you don't know if there's oil there or not. So, the chances of drilling a dry hole are very, very high. That is not what we do in our funds. Maybe one of these days, maybe we'll put together a, wildcatting deal. We had a really cool kind of offshore, opportunity that came in, but the offshore stuff scares me. I don't feel like I'm knowledgeable enough to bring that, but there's a whole different set of problems when you're drilling out in the ocean, and we opted to pass on it. But yeah, everything that we bring to the table is with the majors in proven areas. And we only
Okay.
participate in horizontal wells. We don't do any vertical wells, all horizontals.
All right. And
Um,
then Chip's got a couple other questions here. Can we get any records showing your track record in drilling? And also, he's got one down here as well. Do the projected returns include the tax benefits or just the returns on the performance of the well?
no, so we don't ever include the tax benefits in any kind of returns. I think everybody's tax situation is different and it's going to impact those returns differently. So we don't put that in there. And
Good
Alex,
deal.
that's a good question. How are you able to get into these deals with the majors? That's a good question because Exxon doesn't need our money. EOG doesn't need our money. They are not putting together investments to raise capital to fund their drilling projects. And so I decided years ago that, if I was going to drill, I want to participate with Harold Hamm of Continental Resources. These are multi-billion dollar companies. They're very, very good at what they do. And the problem was, they're not raising capital. So we had to find a way to do that. And essentially, what we do is we figure out, our team of landmen figure out where these guys are drilling. They're pulling permits and figuring out where they're permitting. And then we figure out some individual or company that owns a very small, 2, 3, 4, 5% interest where they're going to drill. And then we go and buy it from that individual. So it's not that Continental asked us to participate or needed us. Once we acquire that interest, they don't have a choice. And so we now own it. It gets recorded at the county level, and then the operator gets notified. They get the documents, and then so once those wells start producing, let's say we have a 2% interest, and the first month it produces $100,000 in income. 2,000 of that 2% of ours is, we get 2% of everything that well makes for the life of the well.
Yeah. Guys, if anybody else has any questions, man, please put them in there. Uh, you know, Mr. Brittingham, Kevin, anybody else got any questions?
Yeah, these were good questions, Chip. And
They are
that
good
you sound
questions.
like you have a little bit of experience in the oil and gas space. And the track records, I mean, I always share. I actually have a document that shows all of the deals that Rick and I have done together, and what those returns have been, and everything like that. I think transparency is so important. Yeah, I'm always willing to share everything. I actually have a data room that we built out for Iron Horse One that has a lot of a lot. It has, like, I have a written track record, and actually our track record is in our PPM as well. It'll have our deals, how those have done. Rick and I together do not have a well that we have done that's dry. I think we have just hit 100 wells that we have done together. I'll have to count them. I mean, he's done his own deals, I've done my own deals, and then we started working together directly and only in 2023. Um, and I think we just hit 100 wells. I'll have to go in and count them and figure out what that number is at. But we together have not had a dry well at all. So,
Yeah, and hey guys, when we do put this out, this was a really an informational type webinar just
oh,
on. Go
yeah.
ahead, Courtney.
No, no, go ahead.
Yeah, this was just really, to kind of catch you guys up on oil and gas and what that looks like, kind of what that investment looks like. When we actually launch the fund, it'll be, could be May, April or May. And so when we put that out, we will have the data room available for everybody, and have all that information out there for everybody to make a decision. And we'll put that out before we open the fund. It'll just be we just don't want to put it out quite yet, but we're just doing these informational, educational type webinars just to kind of prime the pump, if you will, for what we have coming.
Yeah, and Chip, actually everything's done through a limited partnership. For oil and gas, you can't do it in an LLC. It's got to be a limited partnership so the tax benefits flow through. The IRS very specifically says that you cannot have an entity that limits your liability in any way. And so it cannot be an LLC. You can invest like with an LLC, but the LLC will get the tax benefits. And if you've got like investors in there, they don't flow through. So in order for them to flow through, it's got to be a limited partnership.
Yep.
And so those were great questions, though.
Yeah, Chip's always got good questions.
Yes.
Um,
Well, and like you said, this was just, for educational purposes, why you would even want to think about having oil and gas in your deal to begin with. And so,
okay. And you know what? We got a couple other questions in the chat as well. Dwight says, what is the expected term or length of time that my investment would be tied up?
um, so most of the time the deals are, they'll just run forever. Oil and gas is very different, in that you typically get your money back faster than you do. Typical real estate deals is you invest, you get quarterly cash flow, and then, 5 years down the road, whatever the time frame is, the return you see on the exit. Oil is a little bit different in that the cash flow is very high at the beginning, and then it kind of depletes and goes down over time. Because when you drill new oil wells, they produce the most when they first come online, and then it goes down. They deplete, and you've got different depletion rates and everything else in different areas, and that's a whole nother ball of wax. But depending on how the wells perform, how they produce, and what the price of oil is, will determine is your money coming back in 9 months or is it coming back in 3 years? Right now with lower oil prices, we're looking at probably a 2.5 year time frame for, money to come back, your original investment to come back. And then it starts multiplying from there. And then you get those tax benefits in year one as well. So it just kind of depends. Just kind of depends.
Yeah, I mean, we're really looking for a 5 to 6 year
Oh,
turnaround on
so
those, correct?
yeah, what we will do, because, and this is, we're starting to really get into the semantics of all the things.
Yeah, yeah.
We do want to deplete the majority of the oil in the deal, and then we'll exit. And so, and when I say the majority, typically most wells, you're going to produce the majority of the oil, probably 80, 85, 90% of it in that first, 7 to 10 years. Once we have hit that threshold and we have produced the majority of it, we'll go ahead and package those wells up and sell them and exit. So we do want to exit. I can't give you like an exact time frame because there's not a some wells produce a little bit faster, some produce a little bit slower, and then you've got everything in between. And so, one set of wells, it might take them, they might be pretty much depleted, after 7 years, a big portion of it, and there might be some that take 9. So once we've hit that threshold, we will exit. So the goal is to exit. I can't tell you, is it going to be 7 years? Is it going to be 10 years? But by that time frame, you should have hopefully 2 or 3x your money by the time we're exiting.
Correct.
Whatever the multiples are going to be, you have already gotten that back by the time, we have exit. That the exit, you're not going to have a big exit dollars like you see in real estate.
Right. And we actually try, I mean, it's, the main goal here is to return your capital back to you within 2.5 years. And that's conservative, right, Courtney? Um, and then Stephen has a question. How are all fees, commission structures, including sponsor, broker, operator, earn net return? I mean, all that'll come into play whenever we're launching the fund. I don't know if you want to get into all that right now, Courtney, but we
Yeah,
will have all that.
if
It'll
we
all be spelled out.
it will, and we're pretty simple. We've got a one-time kind of fun admin fee at the beginning, and then there's typically a split, and it's usually like an 85-15 split for the life of the deal. And we don't do additional fees, we don't do additional management fees or anything like that. It's pretty straightforward. As far as the operators and all, we are not, other than, cutting checks for monthly lease operating expenses, there's not like deals with brokers, operators, all of these other things. So it's a little bit different, and we can really get into that when it comes time. When we have
Right.
all of the numbers like spelled out and figured out, we can definitely get into all that. But I will say, I think we have some of the best, splits and everything that I've ever seen. Most deals, I've seen as high as a 29% management fee up front in a 50-50 split. A lot of them will start at 70-30, and then go down to 50-50, once return of capital has happened. I mean, we just do a straight 85-15 for the life of the deal. We don't really incorporate waterfalls or anything like that.
Yeah, got it. Try to keep it simple, stupid.
Yes,
That way
yes.
I can keep up with it.
And we don't have nonsense buried in our documents either. I don't like that either.
Yeah.
I don't. And our documents aren't 500 pages long.
Right. So Jemai Battle came in late. Will there be a replay? Yeah, we'll email out the recording to everybody that signed up to be in the webinar. I'm a value growth advisor and transition readiness for healthcare business.
Nice.
Okay, yeah,
Awesome.
awesome. Mr. Brittingham, is there an exception yet regarding minimum investment amount for the fund?
That Charlie can figure, I don't think that we have not sat down and um
Yeah,
like
we'll work
nailed
all that
down
out.
terms or anything like that. This was supposed to be just an educational, hey guys, here's why here's why oil and gas is so awesome. And then here's a
Yeah,
few things that should give you a little pause, but hey,
yeah.
we've got great mitigation tools. So
Yeah, and we'll come out with all the numbers and all the returns and all that stuff. We'll get all that out to everybody for sure.
absolutely.
But yeah, great questions. And Courtney, thank you so much. Does anybody else have any other questions? Here's Kevin. I couldn't see the slide deck well on my phone. Can we see the deck again? And PPT seems like there was a lot of bullets to consider. Absolutely, Kevin. We'll see. We'll shoot you over the slide deck, man. No big deal. Yeah. And yeah, we can send that out with everybody. And there'll be like I said, there will be a recording of this that Kevin's on the go, man. Old Captain's on the go. So he's, when you get home, sit down with a cold beer and watch
I
it
don't know
again.
how you could have seen anything on that PowerPoint on your phone. I had to buy readers like a year ago, and I'm on a computer and I need readers. Like, there is no way I could have done that on a phone.
Yeah. Yeah.
So,
48 years old and I still don't need them yet.
oh, God. Well,
Knocking
I
on
turned
wood.
50
God
this
bless.
year, so
Yeah.
it's coming.
Yeah. Dwight, thank you so much for the compliment there. Guys, gals, we appreciate it. We really do. And myself or Logan will be reaching out to you, or Mafi. We'll be reaching out to you with more information. Courtney, always a pleasure, darling. Can't wait to come hang out. Let's go party at Old Well.
Yes, let's do it. I think we need to do that. I am gonna go once it warms up a little bit more, we're gonna shoot up to the Bakken, and we're gonna hit all of our wells and get some pictures and stuff like that. And we're gonna, go from North Dakota, string down through Wyoming, Colorado, Oklahoma, and Texas and get some stuff. So I'm excited about it. Oh my gosh, something better than Natty Light
For sure, Chip. For sure.
Absolutely. But high school kids, $30 keg, that's what we could afford.
Yeah, I'll be honest with you, man. I'm not really a hops kind of guy. I still prefer the Miller Lite over anything. But guys, thank y'all so much. Courtney, thank you so much. And yeah, we're looking
Yeah,
forward to putting this together for you guys, man.
yes.
I think it's going to be a really good deal. Courtney, the reason I'm teaming up with her is she's just so knowledgeable, and she's forgotten more
Well,
than most people know that are in the
and
oil
I
and gas
appreciate
industry
that.
now.
Yeah, and just to give you just a little bit of knowledge on like the last deal that we closed just in December, we're going to land somewhere at about 40 wells in that we're in actually four basins. We've got 12 operators and we're pretty pumped about it. And we ended up passing on about 92% K1 loss for that deal. So very excited. We've already got several wells that are online and crushing, 1,200 barrels of oil a day, which I'm pretty pumped about. And so we've got about half of those wells are already drilled, actually a little more than half. So good stuff coming from all of that. Yeah, pretty pumped.
Absolutely.
Yes.
Take
So
care, guys.
yes, have an amazing day. And Chip, you've got good initials, CM. All right, thanks.
Take care, guys. Bye bye.